Hello and welcome to Master Budget Part 3. In Master Budget Part 3, we are going to be preparing the direct materials purchases budget. In Part 1, we did the sales budget, and in Part 2, we did our production budget. The sales budget fed to production, and now you can see the first line of our direct materials purchases budget is units to be produced. So we're going to need our production for January. Remember, we always use cell references so that we can make changes to our budget, and our budget is dynamic. It will constantly change as we make changes to assumptions or data. So we're going to hit click equals, and we're going to go up and we're going to pick up our units produced from January and hit enter. Now, the next thing we need is the direct materials per unit. That's going to come from our assumptions. So we're going to go over to our assumptions and down to inventory and production assumptions. And you'll see that direct materials per unit is 2. So I'm going to click on that cell and I'm going to hit F4. Now, what F4 does, as you can see, is it's put dollar signs around. Remember, this gives us an absolute cell reference, meaning that I can copy this anywhere in my worksheet and it'll always go back to C36. Enter, and then direct materials that I'm going to need for the month are going to be my production times the number of pounds per unit. So I'm going to need 4,240 pounds. Now I can copy this across for the 3 months because I've used that dollar sign as my direct cell, absolute cell reference. Now the quarter, we're going to use auto sum, and we will sum that across. The $2 stays the same, and we're going to also use the same multiplication. You can use it again or just copy it over. So I'm going to need 13,920 pounds for the quarter. Now, going back to January, where we said we needed 4,240 pounds, we also have to prepare for ending inventory. We have to purchase enough so that we have ending inventory to start production for the month of February. And that comes from our assumptions. And our assumptions say, and I'm going to put in an equal sign, go back over to our inventory and production assumptions, and it says direct materials ending inventory should be 70% of production. Now remember, we're going to use the 70% all across, so I'm going to use my F4 again. And notice that it's put the dollar signs in, and it's 70% of my current month's production, so times and the 4240. So I'm planning to have enough materials so I can produce my sales plus my desired ending inventory. So I'm going to add these two together. That's the total I need. However, I started January with some beginning inventory, and that beginning inventory is up in my balance sheet. So if I go over to the balance sheet, you'll see that my direct materials beginning inventory was 1,908 pounds. So I'm going to pick that up, and I won't have to produce that amount because that amount is already available. So therefore, I take my total need minus my beginning, and that's the amount I need to purchase. Now, the cost per unit was in my assumptions, so equals, go over to my assumptions again, and the cost per unit is $1.40. Remember, F4, because that's going to stay the same all the time for the quarter. And so total costs will be the purchases times the $1.40, and that's what I will need. Now, I can copy these across, but my beginning inventory for January was my ending inventory for December. Remember, I went and picked it up in the balance sheet. So that means that my beginning inventory for February will be January's ending inventory. Now, we calculated what we wanted to have for ending inventory up here. So I put in an equal sign, and I'm going to pick up that $29.68. Now, same thing for March. In March, I'm going to have a beginning inventory, which equals February's ending inventory. And once I have those in, I can then copy this across so that I have my purchases for each month. Now, going back to our quarter, when we think about a quarter, we're thinking about the months as January, February, and March. My ending inventory for the quarter is the ending inventory for March. March is the last month of the quarter. So I'm going to pick up March's ending inventory, which represents the quarter's ending inventory. Then I'll add those together, and that's my needs. Now, beginning inventory for the quarter is the beginning inventory for January, because January is the first month of the quarter. So I don't need to have produced that to buy that during the quarter. So I'm going to subtract that. Now the costs will stay the same, so I can copy over these equations. And so I need $21,756 for the quarter. Now, you can do a check figure so that you can see if you have done this correctly, or if the worksheet is working properly. And that is, these 3 months should total $21,756. So we do the auto sum, and I'd only want to pick up these 3, and so these 2 amounts here should be the same. Now the other thing we can do from here is we can figure out our accounts payable. Now, our assumption for accounts payable, and I'm going to put an equal sign in so we can pick it up. Go over to our assumptions and down to our cash disbursements. Disbursements are the payable, and it says that we are going to, in the month of purchase, we're going to pay 30%, and the month after 70%. So that 70% represents my accounts payable. Okay, so here's my production budget, and accounts payable is going to be 70% of purchases for March. So I'm going to pick up the March purchases times, go over to my assumptions, down to my cash disbursement assumptions, and pick up my 70% and hit enter, so that I have my accounts payable that will show up in my balance sheet at the end. So there's my accounts payable that I will then put into my balance sheet. So in this demonstration, I've walked you through how to do the direct materials purchase budget. In the next demonstration, we'll do the direct labor. Thank you for listening.